Well, joining me now is the chief UK economist for the British Chambers of Commerce, Steve Hughes. Steve, thanks for joining us this morning. When we look at the report that you've just published, on the surface of it, it looks fairly optimistic, with nearly all the key results showing that the UK recovery is consolidating. But looking a bit further underneath it, it does seem that there are still some major concerns.
Yeah, very much so. I mean, if you look at all the key indicators, as you said, they've all shown growth or improvements on the last quarter. I mean, specifically in manufacturing, where we saw export balances rise, suggesting the weakness of the pound is finally having a true benefit. If you look at the services sector, however, which obviously makes up the lion's share of the UK economy, the growth in those balances and those indicators are very sluggish. The very definition of sluggishness, and they've only risen marginally on the quarter. Then underneath all that, you've got very weak indicators for cash flow, which has obviously been the key story for businesses over the course of the recession, with difficulties with accessing credit and prompt payment times up and down supply chains. And also investment is very weak, which indicates that productive capacity may be weakened in the UK, and when demand rises more quickly, will businesses be able to respond?
So with all of this, are we really in a position where we should be making all these cuts and bringing in these austerity measures? Taking away the financial stimulus, is that going to pull the rug from under British businesses?
Well, there comes a time when you have to let the business community stand on its own 2 feet. The fiscal stimulus, when it occurred under the previous administration, was entirely necessary. And now, under the new administration, the fiscal tightening is entirely necessary as well to calm markets and investor fears. As I say, the private sector has got to take that role on. We have reached a period of relative stability compared to the last 18 months. Firms are more stable, they can take on more staff, and demand has stabilised as well. There are underlying factors in the economy which may harm that, but fundamentally the fears of a double-dip recession have receded from the start of the year.
Now, what about the thorny issue of employment? Because employment seems to be fairly stable, growing slightly. But I think the government is looking for employment in the private sector to really take off in order to balance job cuts in the public sector. Is that going to happen?
Well, if you look at the employment statistics, I mean, we're forecasting a rise to 2.65 million employed by the start of 2011, and that's where it'll peak. Now, prior to a few months ago, forecasts for that employment number were much higher. However, again, the headline figure masks an underlying weakness, i.e. there's a huge amount of people who are economically inactive, and there's also a huge amount of people who are working part-time because they can't find a full-time job. Now, that all contributes to an overall picture of the labour market, which isn't that rosy. However, if you allow companies to employ people, if you take on the issues such as employment regulation, lowering corporation tax, for example, which the new administration has said it will do, also lowering or reducing and rolling back the employer national insurance contributions rise that the previous administration set in train, then that does give companies every chance to hire people and take staff on.
Just very quickly, what do you think of Alan Budd's announcement that he's going to resign?
Well, obviously a bit of a surprise given that the organisation is only in its infancy, but fundamentally the OBR is the right thing to do to take the politicisation out of forecasting from the Treasury. They'll find someone else, and we still don't know the reason why he's left, but it's sad to see him go because he's a very respected man, but we'll have to see where this takes us.
OK, Stephen Hughes, thank you very much indeed.